So today, guys, on PBJ Mortgage TV, we're doing something a little bit different. I have my operations manager here, Patrick, and between the two of us, we've got well over 45, 50 years of experience in the mortgage space. And so we're just going to talk a little bit about some of the questions that we get asked most frequently kind of in our space and some of the kind of pitfalls that people run into. Hello, Patrick. Good to see you.
Hello. Yep, absolutely.
And for those of you who are not aware of this, we're actually sitting about 10 feet apart in separate offices. So
Very
very,
true.
very close together. Very close together. Patrick, I would say, what do you think is the number one question that we get asked either by first timers or people who are doing mortgage again?
I mean, it's kind of hard to say exactly what that number one thing is because everybody has their own way of looking at things.
For sure.
Some it's interest rate, which to me makes no sense.
Okay, so let's take a minute to talk about that. That's a very good point. People ask a lot of us a lot about interest rate, right? That is
Right.
sometimes the first thing that comes out of our mouth, their mouth. Let's have a little conversation for a minute on why that's not always the smartest conversation that they should be having, right?
I mean, the biggest reason why I and a lot of people probably in our industry probably feel this way is interest rate is just a placeholder in a lot of cases. Depending on the rate, depending on what you're looking to do long term, short term, the rate really doesn't make much of a difference.
Well,
The
and a lot of people are going to hear this and they're going to be like, what do you mean by like the rate doesn't make difference? It's not that it doesn't make a difference. What he's saying is there is a lot of complex factors that are actually going into that back end interest rate. And so, number one, what he's saying, placeholder, we don't know which interest rate you're going to get because we don't know all the specifics, number one. And then,
right,
like he's saying, we don't know what your plans are. So, one of our jobs as an expert is to ask you a bunch of questions to try to understand how long are you keeping the property for? What do you want to do, from a financial perspective? Like, how are we trying to grow wealth? Are we going to turn this into a rental in a few years? Are we staying here forever and they're dragging you away in the pine box? Like, what is actually happening with this, loan? And so people have been trained and programmed over the course of time because of millions and millions of dollars in marketing that we should pick only the interest rate. And so it's the first question, the first thing that comes out of their mouth. But you and I both know that that's not the way that you should go about it, which is why, as an industry expert, we get a little bit frustrated with that question, even though we understand why you ask it and we're not mad at you. But it is a little bit frustrating from our side.
it is because we see a lot more of the bigger picture, right? If you're looking at it if you're not looking at it from that aspect, look at it from this aspect. If you buy now, you can afford a house that's worth 450,000. Okay. If you wait for rates to drop, you end up in a situation where now potentially, depending on how much the rates drop, you're looking at 4 to 5 million more people potentially in the market, regardless. And that's across the US. That's not just one state. That's not one geographic area. That's across the whole United States. What you end up doing is now you've got supply and demand issues. Under a supply and demand issue situation, you've got that $450,000 house may go up $40, $50, $60,000, and now you're in a bidding war. So now that $450,000 house is now worth 510. But what if you could only afford 450? Now that same house is out of your price range because of taxes, because of insurance, because of other things that tie into all of that as well.
Well, or they may be buying a higher price house or whatever at the lower interest rate, but oh wait, the payment is actually the same or more than what they would have bought a year, 2 years, or however many years ago. I mean, I agree with you. The interest rate is somewhat arbitrary. It is not as important of a factor. I talk all the time, on not only the YouTube channels, but also my podcast, etc., about how it's all relative, and interest rate is definitely like one of the top 5 most important factors, but it's not the only most important factor. The other thing that we have talked about interest rate wise over the course of time is the fact that a lot of times people who are just trying to win over your business and they're not being honest with you, they will bake in a lot of fees into the interest rate that they won't necessarily tell you about, or they will quote you artificially low, or the fees really low. And then when the actuality happens, when they've already got you kind of on the hook, so to speak, then guess what? You
You're
find
too
out
far
that
down the path, basically, is what you're
correct.
saying.
Correct. And so I always tell it's why my number one kind of pet peeve, I guess, is people who don't really want to talk to an expert. I mean, this is a huge financial transaction, right? The largest financial transaction of your life, usually, and the largest debt that you're likely ever going to hold. And the fact that, somebody is like, oh, well, Sally's uncle's brother, sister's dog's best friend happens to do mortgage, like, great. Do we know if they're an expert? Maybe they are. Maybe they're an amazing expert and they look out for your best interest and they care about you and all the things, which is great. But if they don't, I mean, this is a pretty big debt that you're going to hold. This is a pretty
Well,
big payment you're going to be making, and you haven't really vetted or asked any questions or know sort of what their professional responsibility is in relation to it. That for me is
the other
super
the other
hard
the other
to
side to
deal
that
with.
though is if you go and get into a house at 450,000 at the higher interest rate, right? You can always refinance.
Sure.
The difference is now you're not out there looking for a house. You're not having to worry about all the things you had to worry about when you bought a house to begin with, right? So you don't necessarily, just because rates drop doesn't mean that it means that you can refinance, but you're not as in big of a hurry to do it because you're already in the house. Okay. So you put 5, 10, 15% down, whatever you put down, right? But now you go from 450 to that same house being 510. You've gained that equity, right? Which now means that your loan amount, your loan and your value to the value is potentially lower, maybe allowing you to get away from some of the fees that you are paying as well.
Well, and let's talk for a second about why sometimes, and you're right, because that is a really good way to look at it. But let's talk about sometimes when maybe it's not time for people to buy a house, because I think that a lot of times is not talked about. I do talk about that sometimes, that we have told sometimes customers that we've had that, they may want to hold off, right? Maybe there is some credit, aspects that they want to work on a little bit, right? Figure that piece out. Maybe they haven't really figured out like if they want to pick something permanently, because buying a house is not a short-term investment. You shouldn't be buying a house to live there a year or 2 years, even maybe 3 years. Like you need to be kind of like a 5+ year kind of commitment, unless
I
you're
would
buying
say
something
around
like
3 to 5. I would say around 3 to 5.
right. I mean, I would say at least three, but usually if you know for sure five or more, that's like a safer bet, so to speak, right? Unless you're doing something like rehabbing, like you're buying a property where the intention is, maybe to buy something a little undervalue, fix it up or
Right.
whatever, and then kind of flip it down the path. But 90% probably of most first-time home buyers, or even secondary home buyers, right? Like step up home buyers, they're not buying a property for that purpose. And so we occasionally will deal with people where they think they want to buy a house, but they're not really sure what the future is going to hold in the next couple of years. And they're not willing to sort of make the bet on it. So our recommendation of them is like, hey, maybe it's not the right time for you, right? Like maybe we should think this through about, what we want this to look like, so that we can ensure you're buying in the right time window for what you want and what your financial goals and responsibilities are.
Well, the other side to that too is you could buy if you know you're going to be there for 2 or 3 years, right? It's called life happens. So people can always, things can happen and things can change. But you also have the simple fact of if you plan on putting a considerable amount of money down, you could get away with being there for a year and a half, 2 years, and potentially still gain some wealth out of it, depending on what the market's doing. Okay.
Well, or you could potentially look to turn that into a rental property or whatever, if that was
Exactly, because
something.
you have you have more equity there. Therefore, you can step up one direction. You can do a bunch of different things from that aspect.
For sure. The other thing I think we have a lot of people ask questions about, and you can kind of correct me if I'm wrong, but a lot of people will be asking about how much money they have to put down. And we see sometimes where people are so obsessed with trying to get out of paying private mortgage insurance, or they're just trying to chunk all their cash down. And we always advise that that's really not a great idea. Not because we're trying to, not have you pay private mortgage insurance, because we don't have really a dog in that fight on whether you pay it or don't pay it, right?
It doesn't matter to us one way
It,
or the other.
right. It doesn't matter.
It
But
really doesn't.
we don't want you to be cash poor either. We don't want you in a situation where now you have chunked literally every single dollar you've got into your house, and now it doesn't allow you to do anything like purchasing any furniture you might want for the house, making any small upgrades, or if God forbid something breaks on the property or whatever,
Oh,
that
you
you
mean like an
can't
ice
fix it.
machine?
Yeah, Patrick had his ice machine break today, so he was like, what's going on? So yeah, I mean,
I
and
mean,
the reality is,
that's where you look. That's where you look at things like that and say, okay, where's my threshold, right? In other words, how much money do I feel that I need to have sitting aside in case something does happen? There are things you can do. You can get a home warranty. You can do certain things. They only cover certain things, however. So there's other things in home ownership that can break, things that need to be replaced, things that need to be fixed, things that you decide you want to do. Where's that money coming from? You can't go to the well every time and get a mortgage to do those things. Can you use your credit cards? Sure, you can. You can do various things like that. However, now that's just another payment that you have. If you set money aside every month for a certain amount of time to say, okay, if I want to have $5,000 or $10,000 to do whatever needs to be done, just as an example, now you don't have to worry about it, right? You can have something go wrong and it can get taken care of and it doesn't affect your every day-to-day life as far as your finances. So that putting 20% down isn't necessarily the answer because, like you said, that could drain you. You went from $30,000 in your bank account to $150 because you bought a house. Does that really make sense?
well,
Right?
I know that over the course of time, we've had some people that have been pretty adamant about really chunking like so much money into the transaction. And I always just tell people that hindsight's 2020, and what you don't realize is like you can always put extra money on the mortgage, right? Like no mortgage company is going to be pissed off if you make double payments or you put chunk $10,000 down on the overall, loan or whatever.
Right.
But going back and taking it back out is really hard. And not only is it hard, it's like basically re-going through the entire transaction again, as well
Exactly.
as remind yourself that then you're going to have some fees that you're going to have associated with it.
Well, you're going to have
And
fees, and now you're actually looking at the fact that you may or may not have the equity to do exactly what you want to do because, and it's not just the state of Texas. Everybody pretty much is now limiting, unless it's a VA loan, you're limiting yourself to about 80% loan to value on a cash out.
right, but if it's right, then that is very, very true. That is very, very true. And so that's another thing that we caution people about is like when you're dealing with an expert, what their job is to be able to push back on you, right? Good or bad. So for instance, we've had people who've been trying to bite off more than they can chew, and we've said, hey, I think that this is going to kind of put you in a financial bind. You should consider this. Or the other way, they are a little too conservative. They maybe aren't pushing the envelope quite enough, and buying another $20,000-$30,000 on a house is probably really not going to make or break their budget, but it is going to make or break if they love the house or they don't like the
I was
house.
going to say in
And
about a year they're going to make a decision
right,
and they're going to end up putting themselves in a situation where they either have to, they find another house that's more suitable for what they're looking for, right? And probably what they should have waited for to begin with.
right,
And again, that comes down to time. That comes down to timing, excuse me, but that's where you go, okay, well, I shouldn't have done this. Now I need to do this. And now you don't really make the money off of the house that you bought a year ago because now you're back in that same hunt and you may actually end up in a situation where you may have to bring money to the table if you didn't bring enough money to the table initially.
right.
So it's a strategic game, but who you work with matters in that case too, because some people don't ask the question. A lot of people are A lot of people in our industry are, okay, you want to do this. This is the type of loan you want. Okay, that's what I'll do. Boom, I'm done. Right. And that's the end of it. Some others like you, like me, like a few that we do know, ask the hard questions.
Right.
And,
And I think that
and sometimes that's a downfall for us, but it's also a positive because it makes people think.
Well, I was gonna say, I think that there's a misnomer that, first of all, the mortgage company is working for you. Yes, that's true to a point, but remind yourself that how the relationship is really supposed to look between us is we're partners, right? We are partners in trying to get you to be able to achieve this huge goal of home ownership. And so our expertise is supposed to be that you don't have to have understand the answer to every question. We should be able to break it down for you, help you understand, help you get what's going on, right? That's like the important aspect. And then not only that, but then we're also supposed to, again, challenge your viewpoint. If we think that based on what you shared with us from a financial perspective, it's not going to make sense for you, we should be saying, hey, have you thought about this way? Have you looked at this as an option or whatever? We should be a lot more like an advisor than we should be somebody who's just an order taker and like, oh, okay, this is what you said you wanted. Great. You qualify for that. Let's just give it to you and move on down the path. Because what I see a lot in moms groups is where people got into a house and now they're upset about it just because they didn't have any of these hard conversations. So yeah, whoever they worked with said, sure, you can buy that house and sure, you qualify for that house. And they became the yes man, so to speak. And then they got frustrated because now nobody had the conversation with them about the possibility of their taxes increasing because it was a new build. Nobody ever talked to them about, the fact that things might break on their house. What does that look like? How do you insulate yourself? And so none of these conversations are being had. And so now, where you're in a house poor situation or you're frustrated or you bought an area you didn't really like. And that's not a great feeling and not what we want for our clients. And a true expert should be doing the same thing. They should be asking you questions. If they're asking you to give you information, give them information, etc. Like that shouldn't be a red flag. What the red flag should be is if it's the other way, that
Right.
you
Well, and,
don't get
and
asked
going back
anything.
and going back to, and I know we keep bouncing around because we both have ADHD to save can't save our lives. Um, but going back to the other thing that you were talking about, what's something else that we see on a regular basis that may stop those types of things, right? And you're right. Sometimes it is credit, right? If somebody has disputed accounts on their credit, right? It's going to depend on, that's going to make a dependence on what type of loan program you look at. For example, FHA, you have to remove the disputes, which I tell people all the time now. Hey, we've got the disputes on here. We want to go this route. We're going to have to get these removed before we can move forward so we don't have the same problems when we get to underwriting.
Well, and let's explain what a disputed account is. So a lot of times you can ask the credit agencies, or if you're working with a credit repair company, what's going to happen is that you guys are going to send letters, or you're going to say that the information is inaccurate. Okay. And it's going to put a dispute. The problem is on the mortgage side, we can't have those and be able to do a loan. So it's super
And
important. This is something.
the reason behind that, just to clarify, is because it's not, the credit score that we get is not 100% accurate at that point, because those trade lines that are on your credit report literally do not come into the calculation.
Correct.
So if you recently did it, if it's a recent thing and you did it, it could potentially drop your scores.
Right.
If it's something that's been there for a long time and you disputed it, it may adjust the scores a tiny bit, but not enough to affect you being able to get the home.
Well, and
Or
as
even
we're wrapping,
refinance for that matter.
yeah, and as we're wrapping up, I will say that this is something that we get asked a lot. Like we get told that the credit is one thing, then we pull it and it looks something else. And so for a second, I want to talk about what that is, what that looks like. So this is what's super important for people to understand. There is over, I think it's 300 scoring models in credit land. Okay, so
800.
when we're talking about the three major repository, which is Equifax, TransUnion, and Experian, they have that many scoring models, and mortgage uses one of the most strict scoring models. So when you see on your bank account or your credit card statement or whatever the estimated score, you're looking at Credit Karma, Credit Sesame, any of these things, they're giving you a score. Most of these scores are a lot better scores than what you're actually going to see on the mortgage side. And so I highly recommend you understanding what a mortgage score looks like. And if you are trying to prepare yourself to be able to buy a house and you're wanting to look at that, then yes, you need to be making sure. And what is it? Is it FICO score? Is it 8? I remember the
I'm not
scoring
100%
model.
sure which one. I'm not 100% sure because there's two,
If you,
4, 6, and 8.
yeah, if you go
Two,
and you
4, 6, and 8,
Google,
and then there's also Advantage. There's also the Advantage one that's going to potentially start being used. It's not being used yet,
correct.
but
Well, and
with
so my
Credit Karma and all
recommendation,
of those, they're strictly a consumer
right.
credit score. They're not always as Credit Karma puts out there, and I have seen it myself. It says this is not indicative of what a lender is going to get because there are different factors that are put into and different weights that are put into things depending on the credit model that they utilize.
Well, I mean, their intention is to market. They actually sell the information to be able to get you to utilize buy credit cards and loans and things like this or whatever. So
Exactly.
it's a
Exactly.
marketing ploy, is what it is.
Exactly.
But I'll tell you that if you want to know what your mortgage scores are, first of all, Google and ask which mortgage score, because like I said, I can't remember off the top of my head which score it is we use. But then there are places where you can get that score, or like I said, what we do is for our clients, we can pull what's called a soft mortgage score. They pay for it, and we figure out exactly where they're at, so it doesn't damage their credit. But we know exactly where they're at. So if they need, so this is where I talk about all the time, like come see us early, because if you come to us and you're like, hey, I want to know where I stand, and you're like, first, before I even fill out an application, like I want to know what my mortgage scores look like and what I need to work on. Guess what? We can have you fill out the application enough where we're going to be able to pull the score for you. You'll pay for that. And then we can tell you, okay, this is the things that we probably need to get fixed or change before that. I highly recommend you do filling out a full application, because then we can also tell you if there's any other red flags that we see that are popping up, any income issues, any other kind of issues. And anybody that you work with, guys, and I'm going to say this before we leave, any expert, we're not going to guilt or shame you. We're not going to make you feel bad if your credit score is a 400. We're not going to make you feel bad if you don't have enough income. We're just going to tell you the facts. Here is where your credit currently is. Here is where we need your credit to be. Here is how much income you currently have. This is why we can or can't use set income or whatever, right? This is what
Right.
we need your income to look like now. Our goal is not to make you feel bad about yourself. Our goal is to help you accomplish your financial goal of owning a house or upgrading your house, right? That is what our goal is. And if there's challenges, it's perfectly fine. If we can overcome them and still do the loan immediately, we will tell you that. If we can't, we will also tell you that and tell you how to fix it. Now, not everybody does that in our industry. A lot of people, if they can't do it, they're just going to deny you and they're just going to move on down the path. We don't
Exactly. Yeah. They're
ethically
going to
believe
move
that
down
that's
the path.
right.
They're not going to give you a reason. They're not going to give you a path to where you want to go. So when somebody takes the time to do that, it's something that you need to really consider who you're working with, right? If somebody says, "Oh, I can't do it," and just gives you a blanket reason why they can't do it, oh, credit, oh, income, whatever, right? And they don't give you a path, is that necessarily the individual that you want to work with?
For sure.
I
For
mean,
sure. For sure.
I can tell you a story of a situation not that long ago where literally somebody came to us and they'd been denied 2 or 3 times over a course of a year, 2 years, whatever. And by the time we got done, they were like, I literally thought you were going to laugh at me and tell me I couldn't do the loan. And wasn't that one done in, like, I don't know, we were start to finish in less than 30 days?
Yeah, we do deals very quickly. Well,
I mean,
I
but it's a perfect example of somebody actually taking the time to look and figure out what works and making it make sense. That's why telling us what everything that we ask about, don't leave anything unturned, right? Tell us the whole story. I'd rather find out today
right.
than you go under contract in 45 days and we have 30 days to get it done. And I find out on day 29, there's something else looming,
Yeah, going on. Yeah, for sure.
you
No, and
know?
I totally agree. And Patrick, thank you so much for having this conversation. We'll have to definitely do another one. Hopefully, this kind of gave you a little bit of insight into sort of how, we think as lenders, like what kind of matters, what kind of questions we get asked, because oftentimes you don't know what you don't know, right? And so this is supposed to be informational, kind of to help you frame up and realize that there are experts out there who really do care, and we really do want to help you get into that perfect place. Again, whether it's a first time situation or a move up kind of situation, our expertise is here, and always feel free to ask us questions. And we'd love for you to subscribe to watch more things just like this.